Hi there. Between dividends and share price appreciation, in case you had a choice to choose either of them exclusively, which one would you choose? Some investors out there might be interested in dividends only, others share price appreciation. And I'm asking this question that way because most people, whenever they invest in the stock market, they are typically excited by the question, when will this share price increase? What is the news around this share price? You name it. Very few think and hope that the company's profits are going to increase so that they can mostly make money from the company sharing part of their profits with them, which is basically dividends, as opposed to them being excessively excited about share prices going up. And if you are in Kenya, this video is very relevant for you because the Nairobi Securities Exchange, most of the companies on that exchange are mature companies. And most of them do pay investors dividends year in, year out. Of course, rates vary. Some of the companies pay very high dividends. For example, BAT, for example, Standard Chartered Bank. Last year, they did have a dividend yield upwards of 14%. So, without further stories, let's jump right in this video. By the way, in case you are new here, kindly consider subscribing to this channel, and while you're still at it, drop a like on this video. And also, comment down below in the comment section. I want to hear your thoughts. Which of these two options will you go for? First and foremost, it is important you understand all the ways you can make money in the stock market. And there are only two ways. It's either through share price appreciation or dividends. Share price appreciation is basically where you buy low, then prices go higher, you do sell, and then you make something from a particular sell. Using an example of the Nairobi Securities Exchange, in case you did buy KCB shares at 20 shillings per share, okay, then the price increases to 30. It's gonna mean you'll have made 10 shillings per share per selling of each share, right? And then the second one, which is dividend, instead of you relying on someone buying shares later, the company shares its profits with you. For example, you own 1,000 or even 10,000 shares in a company which pays 2 shillings per share dividend. That is going to mean you receive 10,000 times 2, which is 20,000. Whether you sell your shares or not, this is passive income. Think of it like owning a rental house. The rent is dividend. The house value is share price. Good investors enjoy both. And then, you having understood that, let's now look at why most people only care about share price. Social media has made investments look like a gamble. Everyone celebrates. This stock has doubled. I made 200%. I bought at 5 shillings and I'm selling at 15 shillings. Nobody talks about receiving dividends every year. And here is the problem. Share price depends on what someone else is willing to pay tomorrow. Dividends do depend on actual company profits, basically the company performance. One is driven by market emotions, the other is driven by business performance. That is a huge difference. Once you understand that, you're going to have clarity on which one to select. So, having understood share appreciation, let's look at the power of dividend stocks. Let's have two examples, okay? One company A, another company B, for you to understand nitty-gritties. Company A has its share price increased by 20% and pays 0 dividends. That is nice. But what happens if market crashes? Because yes, markets do crash. And you're going to lose your paper gain in case the market crashes, okay? And then company B, price of share rarely moves, but it pays an 8% dividend every year. If you invest 1 million shilling, you receive about 80,000 shillings every year, whether prices at the Nairobi Securities Exchange rise or not. That income can, for example, pay or assist you pay school fee, can assist you buy more shares, basically reinvesting your gains. It can assist you pay part of your rent, and it's going to help you build wealth. This is why dividend investors sleep much better. Market crashes keep coming. They are not faced by that. Now imagine, in case you get paid dividends, you reinvest all your dividends back. That is where the magic begins, because more dividends are going to assist you acquire more shares. But then again, a share price increase cannot even produce dividends. This is called the snowball effect when it comes to you investing your dividend. And eventually, your dividends begin buying more and more shares at a faster rate. And that is how wealth is built. Let's now dig deeper with examples at the NSE by bringing what I've just talked to you more home so that you understand it deeper. Some companies at the NSE have historically built a reputation of rewarding shareholders through dividends, although dividends are never guaranteed. For example, Safaricom, KCB Group, Cooperative Bank of Kenya, other companies like, for example, Stanbic Holdings, British America Tobacco, which, of course, as mentioned last year, it did pay a total dividend of 14% yield. Kenya Insurance, you name it. These businesses often generate steady cash flows and, when profits allow, return part of their profits to shareholders through dividends. Let's say, for example, you have shares, maybe 50,000, 100,000, 300,000 every year, okay? That income typically arrives without you selling your investment. Assuming company A pays you 50K, other than 100K, other than 300K, that is exciting because you're still gonna own your shares and the company is gonna be paying or sharing with you part of their profits. And of course, these companies are most likely gonna continue becoming more and more profitable, meaning the potential for them to pay you more and more dividends in the future are extremely high. Now, that's the ideal kind of scenario. Let's also look at the scenario where share price matters. Don't misunderstand me. Share price appreciation is extremely important, especially when investing in younger companies which are growing rapidly. Many growth companies reinvest every shilling back into their business instead of paying individuals dividends. And that is perfectly fine because they don't need capital to expand and to grow. The problem is buying companies that don't grow. Assuming the company is young, it is not growing, it is not paying dividends, and their profits are not increasing. Those stocks leave investors stuck for years. If a company is not paying you today, it should at least be creating significant future value. Otherwise, why own it in the first place? Because you who owns it or owns part of that particular company are going to just be going at a loss, more so you relying on market volatility or market fluctuations. And based on all this, my approach will be three ways. Number one, to look at generating consistent profit, okay? And that's why I'll be looking at also capitalizing on share price. Fair enough. Secondly, I'll be looking at dividends reward, okay? And then third, I'll still be keen on room for future improvements or growth. That is going to be the sweet spot for me, whereby imagine in case I did buy shares today, collecting dividends for 15 years, then selling your shares at a higher price. That is a much better sweet spot. Reason being, you're going to remove emotions in your investing. Reason being, if a company is showing it can pay dividends, it has historically paid dividends, it is a mature company, it is doing well in its sector, chances are it's going to pay you dividends in the future. That is cool because you're going to enjoy that each and every year. And also with this, all these business endeavors and fundamentals also mean the share prices are going to appreciate, even if not at an extremely fast rate, which is sensational. That is going to mean, yes, you are enjoying dividends each and every year. And then if you decide to sell, whether it is 10 years from now, 15 years from now, because of a change need in investment, you're going to still make capital appreciation because you're going to realize gains upon you selling your shares. What do you think about this? If you are an investor or a budding investor out there, which of these two do you prioritize? Share price appreciation or dividends? Comment down below. Let's continue discussing. Cheers, guys.